Hi again, everybody. Sam Alley back with another episode of Creating Wealth Through Real Estate. And this week we've got a special for you. We're going to eavesdrop in on the team as they review some potential acquisitions, including the numbers of some assets we're looking to take down. Stay tuned.
All right, everybody here. This is Rick Melero with his Capital Group. Today what we're going to do is we're going to actually go and run some numbers on a property that we're closing on this week to do our final analysis to determine whether we want to move forward or not. Usually in this boardroom session, one of the things that we analyze are basically what is going to cost to acquire the property based on our due diligence, what the valuation of the property is after repair, and then of course we go through a sheet of paper that we have, which is basically our property repair sheet, which is kind of like the scope of work. Whenever we have an actual contractor look at the numbers on a property, if you have 3 contractors go to a house and they don't have the same scope of work, I can guarantee you that every time you'll have a different bid that's completely different than the other one. So what we try to do to minimize those mistakes is we actually have a crew member go to each one of the properties and actually fill out an actual sheet that tells us all the areas of the property that need repairing. We then give this sheet to our contractors will go to the property and then give us a bid based on these specific credentials. Okay? So one of the things we're going to do is we have a property right now called Brookfield that we're going to analyze, and I want to run some quick numbers so that we can all agree on the figures. All right, so basically, this is our project Brookfield. All right, so the purchase price that we have actually negotiated in this particular file is $27,500. Now, obviously, this comes with experience, but you know, knowing this market, knowing we bought literally over a dozen properties last month alone in this market, that tells me that this price is actually a very good price. So what I want to do now is kind of have a gauge for what my renovation costs are, which based on these figures that they have proposed in the actual bid, we're looking at about $5,000 in actual improvements. So this is basically our reno budget. Now you'll be amazed at what our team does, and later on we'll show you physically on site on some of these projects. When we have a budget for $5,000, we actually have quite a bit of capital that we can use to improve the value of these properties, especially when you're dealing with a lower budget community like this one. So what we're going to do is break down some of the rehab that's going to be included in here in a minute. But let me just share with you, based on our broker's price opinion and our due diligence, we feel that the valuation on this property is going to be $45,500. And this is what we call the after repair value. So this is basically our figures for this particular project. So our ARV comes in at $45,500. So let me just do some quick numbers here. So if our exit is actually $45,500, after closing cost, what I can project to come in is $41,860. So this is my projection. Okay? Now my total cost, I'm not going to include carrying cost, even though that's another figure that we create in here. But my total cost, as it stands, it's basically going to be our $27,500 plus our $5,000, which is our renovation, which brings us to $32,500. With these projects, I already have a broken down figure. It's basically $2,200 has been our average carrying cost for these projects over the time of the life. So I just automatically put those numbers in, and my total is coming in at $34,700. Okay? So these are the figures that we're going to look at in order to assess based on total project costs and the total net. So it's very simple actually when you're analyzing a quick deal. Once you understand the numbers of where you're at, you have $41,860 minus your all cost, which is total in, is $34,700, which leaves us out with about a $7,000 profit. Okay? Now, the way that I estimate whether this particular type of investment works is based on my exit strategy. This particular property is going through one of our exit strategies, basically called television flip. That's the category that we put it together in. Now, what this particular property means is that we're buying a property that we're going to improve to sell the property off through a television network. The reason why that's crucial to note is because the reason why we have our numbers this way is based on an exit of 30 to 60 days, which is what we're averaging on television. That's why I can look at the margins based on that and make a decision if it's worth investing a certain amount of capital to get a certain return within a lifetime of 30 to 60 days. So what I'm looking at here is having a total of 7,160 divided by my 34,700, which basically gives me a 20% cash on cash. And that's how we make our figures when we do an analysis. Now, based on these figures that I'm looking at here, and this original analysis that we're doing here, because it reaches a 20% return, we would be willing to take the risk in the investment in order to sell it to our television network. So in this screening, this brief screening, based on the numbers, it does make sense for us to acquire this property. Anything below this 20%, there would be too much risk associated. The reason for it is because we can always expect or anticipate additional costs associated with the property when you're reselling, or if there's an issue that comes up we didn't anticipate. So you always have to have a little bit of margin there available so that in the event that something happens, you still have enough of a margin to justify the timeline of your exit. So in this analysis, we're making a 20% return in 30 to 60 days. I feel comfortable moving forward.